Well, as we've been following, FedEx missing revenue estimates and pulling full-year guidance has some on the street slashing price targets. In a new note this morning, we heard from Stifel. They downgraded FedEx from buy to hold and lowered price targets from $288 to $195. Well, joining us now is one of the authors of that new note, Bruce Chan, Stifel Global Logistics Analyst. So, Bruce, as you were sort of passing through the information that you got from FedEx, what stood out to you that led to this downgrade?
Great. Yes. Well, first of all, thank you very much, Rochelle, for having me here. We've heard a lot today, certainly, and over the past few weeks and months about, questions in the macro. And, I think FedEx in their release last night echoed some of those concerns with their global volume warning. But I think it's really important to parse out, the rest of the announcement, which was, on top of a 7% headline revenue miss, you had a close to 40% operating profit miss. So clearly there's something going on the cost side there at FedEx. And, that's really what we focused on in terms of, the downgrade and, thinking that what is going on to the company is a bit idiosyncratic.
So, Bruce, you downgraded the stock. You cut your price target by nearly $100 to $195 a share. I guess, to what extent, how bad could it potentially get?
I think when you look at trough-on-trough earnings, there's probably $150 as our kind of bear case scenario. So it could get worse. Again, I'd come back to the profit warning and the volume warning there, and that discrepancy between where the miss was in the headline numbers. I do think that, again, this is more of an internal struggle with FedEx. It's more of an internal issue around their TNT integration. And gave us a lot less confidence in management's ability to, number one, navigate the potential storm that's coming, but also a lot of the strategic initiatives that they laid out in their recent Capital Markets Day.
So just to be clear, you would argue this is more a FedEx problem than a global problem. And what does it mean for UPS and perhaps even Amazon, if anything?
Yeah, I think there are two things that are important to point out here. Number one, there are some concerns about the macro and the volume picture out there. I would expect that, UPS and DHL and other companies out there are seeing some volume pressure. But again, if you look at, what happened with EBIT and the, near 40% miss in earnings, most of that, I think, is attributable to the company there. So I think, we'll see some potential pressure on top-line volume growth, but I don't expect to see anywhere near the type of earnings and profit pressure that we've seen from FedEx.
So, Bruce, why do you think the markets are reacting this way on this FedEx news then?
I think there are a lot of people that, are nervous about what's going on right now. As I said, there are genuine reasons to be concerned about the macro picture, the energy situation and inflation pressure in Europe, and, certainly what's going on in China. And I think there is a tendency to want to attach, what happened with FedEx to, that situation and see it as sort of the harbinger of doom. I think they're separate events.
Hey, Bruce, so you still have a buy rating, I believe, on UPS. What sets UPS apart from FedEx here? Why do you think they're better positioned? Is it the fact that they have already taken some cost-cutting measures into account?
Yeah, I think that's a big part of it. UPS has shown under the leadership of their new CEO, Carol Tomé, that they've done a much better job with capital allocation, with cost efficiency, and on top of that, with the commercial pivot. They've been focusing a lot more on high yield business, on SMB business. That's a playbook that FedEx has, essentially tried to replicate, but they've been further behind, and they haven't shown nearly the same type of progress that UPS has shown.
One of the things that really caught my eye that Raj Subramaniam said is, quote, "We are a reflection of everybody else's business." And we go back to Greenspan, who used that FedEx really barometer of the entire economy. Is there still truth to that?
There is, but I think, investors need to remember that FedEx is going through a transformational period in its history. It recently purchased TNT Express over in Europe. That was a major transaction. We're getting to the end of a multi-year integration period, and I think it's clear that that process hasn't gone as well as the company had hoped. The company, recently got a new CEO. Fred Smith, legendary founder, has taken a step back, so there's new leadership at the helm. And, I think the market has changed. FedEx has pivoted from being the, upstart in the ground share market. It's pivoted more towards a yield-first approach, as UPS has done. So the company is going through transition. And again, I think that's what we're seeing reflected in the results last night, and not so much what's happening with the broader economy.
FedEx having its worst day on record here, off just about 22%. Bruce Chan of Stifel, thanks so much for joining us.